Have you ever wondered why the implied volatility tends to go up when the market actually crashes down? And that's a common phenomenon that we tend to see when the market crashes down. Almost every time when the market crashes down, you can see, for example, the VIX going up very quickly and very high. And that's why in this video I wanted to talk about why the implied volatility tends to go up when the market crashes down and how it can help you in your own trading. And if at any point you find this video interesting or helpful, please consider subscribing to my channel and liking this video. That really be the best support you can give me, and I'd really appreciate it. And if we look at the SPY, for example, the ETF tracking the S&P 500, and you look at when the market is crashing, whether it's the COVID crash or any other crash that happened before, you can see that its implied volatility, represented by the VIX, tends to go up when the market is crashing down. And that's something that you can see over and over whenever the market is crashing. But what is the reason behind this? Why does the VIX tend to go up when the market is going down? And as I mentioned in other videos, the implied volatility tends to be a reflection of option prices, meaning that the more expensive the option price is, the higher the implied volatility, and the cheaper the option price is, the lower the implied volatility. And this type of phenomenon where the implied volatility goes up when the market crashes down, it happened several times, whether it was during the COVID crash, whether it was in the 2008 crash. It's something that we can see over and over. And to understand why this happened, why there is this phenomenon of seeing the implied volatility going up when the market is crashing down, we need to understand two things. Most of the people, when investing in the stock market, are usually long stock, meaning that they are in a buy and hold approach. Hence, they are following what the market is doing. If the market is going up, they're going to make money. If the market is going down, they're going to lose money. That's usually how most of the people invest in the stock market, whether it's through a 401k, whether it's through a retirement account. That's usually what most people are doing. And the second thing to understand is that the markets tend to crash down a lot more than what they crash up, meaning that it's usually a slow grind up that we tend to see and a very speed and very fast crash down. To understand why there's such a relationship between the market crashing down and the implied volatility going up, we need to put ourselves in the shoes of someone who would have, for example, a 401k, or who would basically only use a buy and hold approach when investing in the markets. If you were investing only in the markets with a buy and hold approach, what would be the hedge? Meaning, how would you offset the risk of a potential crash? How would you make sure that if the market is actually crashing down, how could you cover yourself so you don't lose that much money? Well, one of the things that you could do if you were, for example, in a buy and hold approach would be to buy SPY puts. And by buying SPY puts, you basically hedge against a potential crash, meaning that if the market crashes, because you bought puts on the SPY, if the market were about to crash or were crashing, well, you could make a lot of money by doing this, which would offset the losses that you would have on your long stock portfolio. And that's something that a lot of people who have long portfolios will tend to do. They would buy a lot of puts so as to offset the potential losses if a market crash would happen. But if you were in a position of someone who has long exposure on the markets and you were willing to buy puts, you can imagine that you wouldn't be the only one willing to buy puts. So what would happen to the puts? Well, as a lot of people would be ready to buy puts at a certain moment because of the fear of a market crash is increasing, well, what happens to the put prices? They increase. And put prices start to increase more and more people are ready to buy puts. And that's really a natural law of supply and demand. As more people are willing to buy puts, put prices are going to increase more and more. And now we understand why, for example, the VIX is going up when the SPY is going down, is crashing down. It's because a lot of people are going to start buying puts so as to offset their potential losses against a market crash. And that's why the prices are going up, and that's why the implied volatility is going up too. And if we go further, there is something that we call the volatility skew. And we can visually see the implied volatility for puts and calls. And you must have seen this already, where you have this type of graph that is what we call whether volatility smile or smirk, where puts are usually more expensive than calls, and we can visually represent the implied volatility using this type of chart. That's why if you see this after in the video, it's completely normal. It's the way to represent the implied volatility for puts and calls. Meaning that if we look at each calls and puts that are available, you can see that there are different implied volatilities for each and every single one of them. And what we tend to see in general, for example, for indexes for the SPY, which is the ETF tracking the S&P 500, we can see that the puts for the SPY usually have a higher implied volatility than the calls for the SPY. And what does that mean? It means that there is a higher demand for those puts as a way to hedge long portfolios. And that's something that appeared after the 1987 crash, meaning that prior to this, we would see the same implied volatility for puts and calls, meaning that there were a bigger demand for puts in case of a potential crash. And that's after this 1987 crash that people who were long stock, meaning that they were only using a buy and hold approach, started buying more and more puts as a way to hedge their portfolios against a potential market crash. And prior to the 1987 crash, a lot of people who were long stock on their portfolios got burned a lot during the market crash. That's why after that, a lot of people started buying puts on a regular basis so as to hedge their long stock portfolios. And that's why after this 1987 crash, you could see that the implied volatility for puts across the stocks and indexes are now usually higher than the calls, because there is a fear of a market crash and people now hedge their long stock positions with puts. But instead of a downside skew, where puts are more expensive than calls because of a fear of a market crash, you could also have an upside skew. And that usually tends to happen with volatility products. And volatility products such as UVXY or VXX will tend to crash up very quickly if the market crashes down. And that's a relationship because of how the volatility products are calculated. And if the market crashes down, you will see this type of product crashing up very quickly. And because of this, there is a fear of a possible crash up for this type of product. Hence why on this type of product, we tend to see an upside skew, meaning that the calls are usually going to be more expensive than the puts because there is a bigger chance that this type of product is going to crash up rather than crash down. And they're usually going to have a slow grind down and have a very sudden crash up. Now you understand why the implied volatility tends to go up when there is a market crash. It's because of the put prices that tend to go up because people are trying to hedge their long stock positions with puts. I hope this video helps you understand why the implied volatility tends to go up when the market crashes down. If you have any questions, please don't hesitate to comment them below. I'll happily answer them. And I'll see you in the next video. In the meantime, I wish you all the best.